All right. Thank you everyone for attending this month's market update webinar for the month of June 2026. Let's start with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated are not guaranteed. Please be sure to first consult with a qualified financial advisor and or tax professional before implementing anything discussed within the presentation. And of course, past performance is not a guarantee of future results. You can see more disclosures on our website if you so choose. And throughout the webinar, please feel free to use the Q&A button at the bottom to submit your questions, and we'll address them at the end. A little bit about us. So Silverstone Financial, the firm, is a fee-only fiduciary independent wealth management firm. We provide comprehensive wealth management services, including financial planning, investment management, tax preparation, estate planning, and so on. You can learn more about us on our website. And my name is Jeremy Eppley. I'm a financial planner that specializes in inheritance and gift and estate planning. And my co-host here is Gordon Achtermann, another financial planner who specializes in retirement planning and values-aligned investing. Let's hop into the markets, shall we? So May 2026, an interesting month. You kind of see a tale of two markets. It's very clearly on this graph. For those of you that are listening via the podcast, we'll try to explain it as best we can. But we're looking at a heat map right now. This is my favorite way to look at the markets. So the larger the square, the larger the company. They're organized into different sectors and industries. So you can see technology on the left here, financials in the middle, energy, which would be oil and gas. Down here, utilities, consumer defensive over on the right, healthcare up in the top right. I think they got shifted around slightly since last month or 2 months ago, where they were slightly arranged slightly differently. But you can see on the left side, the entire left is all green. Everything that's technology is bright green. And then everything in the middle and to the right, essentially, is some shade of red. And so the brighter the green, the higher the performance for this month. The darker the red, the worse the performance for this month. So really interesting to see a kind of a continuation of what we saw at the beginning of this year. We definitely have seen this AI boom. We'll discuss if it's potentially an AI bubble continuing since the beginning of this year, really accelerating. The biggest winner for the month, also for the year, I believe, right here is MU Micron. It's a semiconductor manufacturer who really took off at the beginning of this year, kind of crazy. For the indices on the side over here, we see the S&P top 50. So this is the 50 largest stocks on the U.S. exchanges. That was up 5.7%. The S&P, which is a little bit broader, has 450 slightly smaller but still massive companies, up 5.2%. S&P GARP, one of our preferred ways of investing, so this growth at a reasonable price. It's a little bit more of a disciplined investment strategy. It still is looking for growth, but isn't necessarily buying the high flyers. And we can see right now the high flyers, these AI tech stocks, are really booming. S&P GARP is only up 2.7%. So it's continuing a trend for the past many months where these large tech companies are outperforming what we'd call more traditional finance metrics of looking for value companies that have growth and have some good fundamentals behind them. Now we see this every so often where these high-flying growth hyperscalers are beating out other parts of the markets. Small caps up 1%, so still up, but significantly worse than the largest companies. The smaller companies performed, had much more of a struggle for this month. Global ex-US, those are non-US companies, the international equities, that's up 4.7%. Still quite good, especially when you compare it to the rest of the U.S. market that isn't the top 50. Quite a good month, but still underperforming the mega cap tech stocks. U.S. aggregate bonds up 0.3%, kind of normal for bonds, up slightly. And we see gold flat. Gold's been doing a lot over the past few months, and so seeing it down 0.8% is not very significant. Bitcoin down almost 4%, another relatively insignificant move for Bitcoin since it's a pretty volatile asset class and sometimes can be much higher or much lower than that. And then crude oil falling 17%. Not saying that crude oil is low, but it fell off its peak since last month. What do you see in here, Gordon?
Well, just on the crude oil thing, it was interesting. This afternoon, we had a service provider in our house came in, and and the first thing he says to me is, "I saw gas down to 370 something or whatever." He was all happy. Um, you know, so it's funny. Direction is sometimes more important in people's attitudes than the actual price. And I feel like May was a month of kind of some things catching up where we have US stocks catching up still year to date. I think we'll see not quite caught up to ex-US, but let's not get ahead of ourselves there. But also, um, the value growth split. It was a month of catching up. And um, yeah, I feel like gold and Bitcoin being relatively stable for those asset classes, um, probably a good thing. I think with all of the attention on the chip makers and the coming IPOs in the AI space, that um, a lot of the speculative energy is moved away from kind of these inflation hedge options. And so maybe a little less speculation going on in the bottom third in the commodities section of our monthly look there.
Yeah. Before I switch slides here, I want our viewers to look closely at this map and see what changes. Because to be fair, I'll spoil it a little bit. It doesn't change that much. You'll see some green appear here, and kind of everything else will look very, very similar. So let me switch the slide over, and we'll see year to date, not a huge difference. You can really see still this left half bright green. Microsoft not doing as well, but almost everything else quite bright green. And then we see energy also pretty green, industrials greener than in the past month. So, of course, energy up because of the war in Iran and all the energy crisis making oil prices higher, which benefits oil companies, energy companies. But a lot of it is very much the same. We see the S&P 500 performing quite well, 11% so far this year. However, we do see that smaller cap stocks have performed better than large cap stocks year to date, which is surprising to me. We also see global ex-US performing quite well similarly, where it's up 14% year to date. And we see bonds up 0.6%, crude oil up 52%. So really interesting to see all of this. Yeah, anything you see on the year-to-date chart, Gordon?
Well, yeah, I just think small caps are kind of the underappreciated thing. Most people, if they have a specific allocation to small cap, it might be 10 or I mean, there are stock pickers who feel like small cap is really the area where individual drilling down into the balance sheets and into the income statements of companies can really pay off. And it's it's really quite remarkable how the small cap market has held up. And specifically small cap value is Among the small caps, the value section of that is, I believe, the best performing year to date. So kind of some unsung heroes. And like I said, so you see global ex-US still the high is, other than the crude oil price, is the highest number on here. I'm sorry, after small caps. But the highest really broad in terms of market capitalization number here. And US is catching up, but still 9 to 14. That's a pretty sizable, about a 5% lead for ex-US. Also, Google and Microsoft kind of switching places from the monthly. Interesting. Microsoft feeling a little bit left behind in AI. They put a bunch of money into OpenAI at one point in partnership, and now they're starting to realize, oh, maybe we need to grow our own a little more. They're starting to work on their own chips and their own AI infrastructure. And so it'll be interesting to see if they are able to, if their efforts to catch up start to show up in their stock price. May was good for Microsoft, and we'll see if they can bring the summer in and catch up to a positive number.
Yeah, I saw some interesting commentary from some market analysts maybe a week or two ago, and it was talking about their belief was OpenAI was overvalued and unsustainable, and that was dragging on Microsoft's performance, which is somewhat surprising because OpenAI has been going up. But their thought behind it was, well, if OpenAI goes public in the coming months and then really suffers over the coming years and either goes into bankruptcy or goes near bankruptcy, where it's a fire sale or they're looking at buyers. Microsoft would most likely be the one to buy it since they already own, I think it was 30 something percent. They had originally owned
Wow.
49%, and it fell because they've brought on more investors, so they got diluted. But yeah, if various companies are trying to buy up the various tech AI companies that might not be sustainable with their own business model of how do I make revenue? Because Microsoft and Google have their own revenue drivers and are trying to do AI on top of it, versus Anthropic and Microsoft are starting from scratch. So they don't have their ad businesses or their enterprise businesses that can support all the new AI stuff. So it might be interesting. It could be interesting to see where Microsoft will be in a few years, and might be a contender.
Well, yeah,
Oh,
Microsoft is an octopus. I mean, the CEO strategy from when he first started there has been partner with anybody, be part of everything that's happening, and connect up different pieces of the tech infrastructure stack. And Google has a lot of their revenues dependent on advertising. Same with Meta, these are in communication services because they're basically ad running technology companies. Microsoft, very different, and it might be a good way to play the whole AI question of how much of your investment dollars belong in AI. If Microsoft is the logical partner to get it during some kind of a dip, that in the more long run, that could turn out to be great.
you said something right there that brought a red flag in my head, where if you think about how many dollars are actually concentrated in AI, like if you think about it, I think Amazon and Google are investors in Anthropic. Microsoft has 30% of OpenAI. Soon enough, there'll be OpenAI and Anthropic on the open markets, and the S&P and some of these other indices will hold it, but also hold Microsoft. And NVIDIA also has investments in OpenAI and Anthropic. So not only will your be concentrated in heavily in each of those, which I have a graph later on talking about the concentration of these mega cap companies all on the S&P and other indices. It might be even more concentrated without you being able to see it because of how these mega cap companies all own parts of each other. And if AI ever went kaput for some reason, it could really drag large swaths of the market, or at least large swaths of the indexes down because they don't necessarily capture the whole market as well as they used to, which we'll get to that graph soon enough.
Yeah, one last thing. I did mention that in my weekly newsletter, which came out a little later than usual this morning, and yeah, it's almost like the interlocking directorates that we had during the trust era, and it makes it hard for government to regulate when there's so much at stake for the economy. Um, so yeah, interesting times.
Could it get more interesting? Hopefully not. We'll see. Um, All right, so this is another graph I like to show. I'm not going to spend too much time on it this month, but this is a graph that shows the seasonality and cyclicality of the stock market. So historically, you can see the outside ring here. It shows the historical average expected return of the S&P 500 from 1950 to 2017. So it is getting to be 9 years old now, some of the data, but it still does show a good sample of, you can see November, December, April are some of the best months historically in the stock market, just on average. And August, September, this third quarter here is the worst quarter historically on average. And the inner circle, I've put in the S&P 500's actual return. So we saw January it beat, and then February and March, mostly because of the war, underperformed. And then April is almost 10 times, slightly less than that, but quite an outperformance historically. But it is historically one of the best months. And then May, which is kind of a toss-up month, we were up 5.2%. Year to date, we're 11.1. It'll be interesting to see. It might be that we've run up a lot, and we'll give some of those returns up in June, July, August, September. But we're up a lot mostly because of the hype around AI. And I don't necessarily see that hype slowing down as these mega cap names IPO with SpaceX and Anthropic and OpenAI, which we'll get to later on in the presentation. But you could see, all the hype just ignore historical trends and just see new highs, new highs, new highs until something eventually breaks. So we'll have to see. All right, so this is the graph that I have been alluding to before. This is from Morningstar. I really liked this graph when I saw it. You can see the concentration of assets in what they call the Morningstar US Market Index. So it's their own custom index, but you can think of it as the S&P 500. It's very similar. It just captures basically everything in the markets and weights it from a market cap based system. So you're looking at the largest companies having a heavier weighting and the smaller companies having a smaller weighting in these indices. And going back to the dot-com bubble, we saw the dot-com bubble concentration peak at 23-ish%, almost getting to 25. And then it fell as the bubble burst. And then we saw some concentration spike up in 2008. I guess maybe because of mergers that we saw when the banks failed. Not totally sure what caused that interesting quick spike here. And then it fell again down to end of 2010. Then we saw a nice little spike again, and then it fell down to a low here below 15% in 2014, 2015, which actually that surprises me how diversified these indexes were back in the mid-teens. And then since then, we saw Apple and Google and Amazon and Meta, which is Facebook, and all the mega cap tech names that we all know now who have just crushed everything else, all the other performance in the markets, start to grow. And as they grew, they took up larger and larger portions of the index. And we got to end of 2019, we were at 25%. So this is right before COVID, and that was higher than it was in the dot-com era. And then we saw some spikes and volatility, and then it started taking off again. After 2022, there was a whole lot of growth and continued growing, and now we're at all-time highs, the most concentrated we've ever seen for these market cap weighted indexes. So this one, again, the Morningstar one, seems to be 35% is in just the top 10 holdings. I pulled the S&P 500s, which is very similar, but again, structured slightly differently. We're at 37% in the S&P 500. And I would expect just in a few months, probably by the end of the year, because of the mega cap IPOs with SpaceX, Anthropic, OpenAI, that because some of these are coming in and they're IPOing at values higher than some of the top 10. So it's going to be getting more concentrated. It's knocking, I think Berkshire is getting knocked to the 11th place, just for an example. So they're IPOing larger than Berkshire Hathaway. We could see this at 40%. So 40% of your money being in just 10 holdings. And those 10 holdings, a lot of them having interlocking, overlapping investments in each other. So we're getting really, really, really concentrated. So that is one of the things that we're somewhat concerned about. And one of the ways that we invest our clients' money is we do direct indexing. And we direct index not the S&P 500, but we direct index to growth at a reasonable price indexes. And we do a blend of those. And it helps flatten out some of the holdings. Now, you can't really fully diversify away, or you're just not holding what the market's holding at all. Like our top 10 holdings is 30%. So it's not it's 7% less than the S&P 500, but it's still higher than it was in the dot-com bubble because you still the growth at a reasonable price is saying that Google and Nvidia are still good companies to invest in. They are growing at a reasonable price. They are a good investment, at least per the index. And so you got to invest in them, and they're still massive, which means they take up a large portion of the portfolio. So it's something to worry about. It is one of the reasons we're going into June is our managed account review month, and some of our clients have underperformed this year with some of each of them have customized portfolios, so some of them outperformed, but some of our clients have underperformed because they hold a lower weighting in these mega cap tech names, which have crushed everything else. So trying to be a little bit more diversified, a little bit safer, a little more discerning in our investment strategy can be difficult sometimes when everything is hype and growing constantly. It's sometimes hard to have a disciplined investment approach when you see your neighbor, buying, back in the day, Bitcoin and Bitcoin's up 1 billion, or, buying here Nvidia and then talking about how all his money is in Nvidia and beating everything. It's difficult to look at the broader picture. So I really like this graph. Do you have anything to add here, Gordon?
Well, a lot of people I've talked to in the last 3, 4 months are concerned about a bubble forming and see this as a big risk. Um, I agree. Usually markets climb a wall of worry, and it's not until there's some really defining change that the bubble deflates. And that could be around global energy supply. The Gulf is pretty much blocked, but countries are, using up their reserves. But at some point, uh, Japan and South Korea will run out of oil if we don't get the oil flowing through the Persian Gulf again. And that could be an inflection point globally. So for now, we're climbing the wall of worry, and we'll just have to, yeah, it's a risk for sure.
You mentioned something that makes me want to go on a tangent really quickly, since it's not in our notable events later on this month. But you had
Hmm.
mentioned South Korea, and we had this discussion just a few days ago. You and
Right.
I, one on one, and we were talking about how South Korea has been one of the best performing markets this year, and a lot of that comes down to Samsung being in South Korea, being based there, and they are a big chip maker and have really taken off on this AI boom. And I had heard a statistic. I have not double checked the statistic, so take it with a grain of salt, but I do believe it to be true. Where there, the union there for Samsung, for all the workers, they were threatening to go on strike to try to get some bonuses, some raises, and such. And Samsung had its most profitable quarter ever this past quarter. And so they were saying, if you bonused every single employee in Samsung, from the executives all the way down to the janitors, every single employee, if you bonus them $340,000 each, you would still have the most profitable quarter of your history. And that kind of shows two things in my mind. One is that these AI companies are really printing money, especially the semiconductors. Like, just seeing that visualization, they have thousands and thousands of employees, and the janitor could be bonus $340,000 and it not even be worse than 2 quarters ago. Wild. The other big thing that I see there is that we talk about a bubble, and it is still a fear, and we're still investing in a way that is trying to be more disciplined, a little bit more diversified, trying to hedge this as we can without, fully giving up participation in the really impressive growth that is AI. So we're trying to participate in all this, but like, we're a little bit trying to I'm losing my train of thought here. It's such a shame. The ah I lost my train of thought. Gordon, do you have anything to say while I try to think about it? Remember what I was saying there? Uh,
Well, it's funny, talking about Samsung and how, I mean, this is a manufacturing company, right?
yeah,
I mean, probably 100,000 employees. I have no idea. I haven't like looked at it.
yeah,
But when I worked at Freddie Mac, we were one of the five biggest companies in America in terms of assets. Trillions of dollars of assets, and we were only 3,500 employees. Um, so and also I wonder like how they came up with 340,000. Is that like a million? What's the South Korean? Is it South
yeah.
Korean yen? No, that
Yuan? No, that's
you.
Chinese. Yen is Japanese.
Yeah.
My sister studied abroad for a year there, and we visited her. I really should know, but I don't remember. Uh,
But whatever their currency is, it's probably like that's probably a million of whatever, they're saying. You could make
yes,
every one of us a millionaire.
yeah.
And in their
Think it's
currency.
1,000 is there. It is. I remember buying some sort of soda, and it was like 1,000 or 10,000. I don't think it was 100,000 like Japan, or whatever that conversion is.
Hmm.
But yeah, it's 1,000 or 10,000. And yes, I think you're right. It would make all of them millionaires if they had done that bonus. Uh,
Hmm.
and they did get some level of bonus. I think it was like 40,000 or something similar. And I don't know how it was distributed
Good.
versus like Japan versus not Japan, but there was some sort of. Uh, oh, we got a message here. 262,000 employees, half in South Korea. So yeah, quite a
Thanks,
large
Greg.
company. Uh, so I remembered my train of thought. Hopefully, I'll be able to recreate it slightly. I wrote it down so I wouldn't forget again. I was building up to saying we're worried about a bubble. However, a bubble, if you go back to the dot-com bubble and you look at the valuations were crazy. And most of that craziness came down to there wasn't earnings power, it was anticipated earnings power. Versus when you look at the actual earnings of NVIDIA and the actual earnings of Micron and the actual earnings of Samsung, like, the money is there. They are getting their money, and the reason that they're so valuable is because they're actually being paid. Now, there's some argument and to be made that some of the stuff is like stock being traded back and forth, but there's still cash being traded back and forth for these big purchases. So there's definitely fears about bubbles, but and there's always the fear about it. It's different this time, and so in finance, saying that. So we're trying to think in way, is it different this time? Is it like there is earnings power, but the valuation, and specifically for me, more so than the valuations, is the concentration risk is getting higher and higher. So that was the point I was building toward before I lost my train of thought.
Well, I would say yes, there are earnings, especially in these chip makers, but um, a lot of the companies like Apple and Microsoft and Berkshire, enormous cash hoards that have been built up over decades.
Yeah.
And, they're investing in AI. And if productivity gains don't materialize, if companies are buying and paying for the tokens to run things on AI, but if the productivity gains don't materialize, then the funding between the different tech companies will evaporate, and the chip makers and those that have real earnings, those earnings um, won't grow
Yeah,
anymore.
I'd seen an interesting webinar with I believe Dan Niles, who runs a hedge fund, and he was talking about the different AI companies, and one of them, of course, is Google, and it was his opinion. It's also my opinion that Google's the best position to take advantage of actual having AI. Like they already have search. People are looking for answers to questions. Plug it in. They have advertising built in. There's a huge budget. People are willing to have advertising in Google. Easy. Okay. Anthropic is a different one where they're a little bit better positioned than OpenAI. OpenAI seems to be in the worst position because they're trying to do B2C, selling their subscription to customers directly and or maybe advertising, and it's hard for them to generate that revenue. But looking at Anthropic, they are with Claude Code and other of these options where they're trying to
Mythos.
the business to B2B, business to business, and we see that revenue being built much more sustainably. I don't know if it's sustainable, but more sustainably than OpenAI at least. But what his point was that AI might be successful, and there was the fears of, well, are there going to be like job cuts and such? And so open AI might be successful, but what will happen to the rest of the economy? Not necessarily like job cuts, but even there were stories about, I forget which mega cap company it was, but they had like a $500 million bill that they didn't realize was coming because all their software engineers were using so much Claude code that it was just this massive bill that they were not expecting at all. And his point was these CFO of companies have told the market that they need to meet certain expectations. And so if they're having these productivity gains with AI, but these productivity gains are coming with huge bills along with them, what are they going to cut? Are they going to fire employees? Maybe, maybe not. But also, they could be cutting other parts of their cost structure and trying to squeeze every penny, or cut less shipping routes, or whatever it ends up being. It could have trickle down effects just because of these token costs with Claude and such, that we could see maybe there's less shipping. Again, I'm making that up as an example, but like there's less shipping and we see UPS crashing, and it's like there might be unintended consequences with AI that a lot of people haven't even thought about.
Mhm.
Anyway, um, so moving on to, we both went on a little bit of a tangent there. So hopefully you're all still with us. We have fewer notable events this month. A lot of it was, the war in Iran, which we're not even mentioning here. It's kind of a given now. But we have a few notable events, two slides, and I think Gordon's going to start out on this one.
All right. So, if you may remember, Stephen Mirren was appointed by President Trump, and he took on the role of being kind of Trump's in-house job owner. That's what they call it when The president tries to talk the Federal Reserve into lowering interest rates in order to stimulate the economy. When the president tries to get the Fed to do what he wants, it used to be called jawboning. Um, but Stephen Mirren was his in-house jawboner, I'll call him. Interesting thing, uh, Powell is resigned, or I mean, his term was up rather. He wouldn't resign early, but his term was up from the Fed, but he is staying on the board of governors. And so, in order for Trump to install Kevin Warsh as the chair, somebody had to step down. And so that was Mirren. And so he's gone and Warsh is in. So the actual voting dynamic won't change very much. As the chairman, typically they try to build consensus, and the chairperson almost never votes against the majority. So we'll see if Warsh is any different. We'll learn that very soon. But my suspicion is that the Fed will be a little more unified and without Mirren in there, being the outlier, voting for cuts when everybody is looking at the inflation numbers going up, as we'll talk about in a second. Um, Two things that Warsh has talked about ambitions for his term. One is reducing the balance sheet of the Federal Reserve. So during Powell's tenure, he is allowed um, securities that the Fed accumulated during the great financial crisis. And they did some buying during COVID as well. But for most of the time, he's been allowing things to mature, and that's called letting things roll off the balance sheet. So um, when the Fed acquires mortgage-backed securities and buys treasuries and things like that to keep the financial system stable and smooth things out, they buy bonds of different durations and different time periods. And so when things mature, if you don't replace them, you just get your money back and then the balance sheet comes down. And so that's been happening for most of Powell's tenure. Warsh wants to at least continue that, and he's talked about looking for opportunities to actually do some selling. Um, what happens if they do that is that could push rates up because rates are set by the free market, other than the very, very shortest term rates that the Fed sets. So if the Fed is going around selling, um, say, mortgage-backed securities that still have 5 years left of payments on them, then that would drive up the supply of bonds, which would mean the interest rate would have to go up in order to attract more buyers, or the effective interest rate goes up because the price is coming down. Um, it's kind of, as always, bond math is a little unintuitive, but there you have it. It's a tricky thing to do what he said he wants to do. The other thing is that he wants to change the regulatory structure of the Federal Reserve a little bit. And we don't have many details. We don't have any concrete proposals on that yet, but that's something to keep an eye on. A lot of people would say that Greenspan's adjustments to federal oversight of Wall Street led to the great financial crisis in the first place. Some would also say that, well, the reaction to that crisis, Dodd-Frank and other bills that came early in Obama's presidency, were the pendulum swinging too far. Well, so Warsh wants to swing the pendulum back toward deregulation. So we'll be keeping an eye on that very closely when we see some concrete proposals or actual changes announced. Okay, so that's the first two bullets there. Um, April inflation measure reached is 3.8% year over year. And, personally, I bristle a little bit at the dominance of the year over year metric in financial headlines. So sometimes that number changes simply because there was something 13 months ago that had been part of that year over year, and there's a big number, and then that disappears from the statistic because now it's 13 months ago, whereas we're only looking back 12 months. Um, so, for instance, you look at this number, the inflation measure went up. So in the chart here, you see on the far right, that's the April number at zero point 0.8, I believe. Or is that,
It's
no, zero
point
point
0.6.
0.6, sorry. So that was zero point 0.6. So all that means when we say that the April number went up, that means that the most recent month is higher than the one that just rolled off. So we have the measure going up, and yet the month over month actually came down. March was revised up a little bit, and so March was actually the really high inflation month, and of course that's when the war in Iraq started, and gasoline prices really spiked. So kind of makes sense, but we'll see. Personally, I think like looking at the 3 month average, and then maybe you could come up with an annual comparison. But if you just look at the last 3 months there, zero point 0.8, zero point 0.9, zero point 0.8, and zero point 0.3, all
0.6.
in, that adds up to 2% in one quarter. So if we continued on like that for a whole year, it would be more than 8%. It's because that would be like compounding. Um, so inflation, zero point 0.6 in a single month is pretty darn high. Hopefully that won't be sustained, and this will just dissipate somewhat. But higher fuel costs mean higher costs for transportation, everything from jet fuel. It's not just plane tickets, that's moving all kinds of freight by air. It means diesel trains and diesel trucks. Diesel, of course, is made from heavier crude, and that's the thing that's most in short supply. So that's why diesel fuel prices have gone up more even than regular gasoline that you and I burn in our cars. So something to definitely keep an eye on. Um, but why wasn't last year, last month, the alarm bells going off? That was the really crazy high one at zero point 0.9. Um, my rant against the financial media ends here. Okay. Softer U.S. GDP growth beneath headline resilience. So, similarly to what we were just talking about, we did have some GDP numbers come in that were uh, a little bit less than we had experienced before. And
Half a
uh,
percent in real GDP, I think, was the fourth quarter of 2025. Yeah.
um, right, 0.5%. And so, GDP is so hard to actually measure. It's always revised a little bit. But when we look at 2026 so far, again, that's a big come down from the prior month where it was a 2.7% annual rate. So uh, it's the trend that is worrying. We're not in a recession by any means, but when you have growth slowing and inflation rising at the same time, um, usually that leads to unemployment following. And so we'll see if the numbers, in that area start going in the wrong direction. That could be a signal of bigger problems ahead.
All right. So let's move on to I guess this is more so my slide here with five notable events. So the first one was that Berkshire Hathaway is acquiring Taylor Morrison, which is a home builder, for $8.5 billion. So Berkshire Hathaway, of course, Warren Buffett's essentially investment company, recently turned the reins over to Greg Abel over here. And both of them have had huge record stockpiles of cash. I forget the exact number. I don't have it in my notes right here, but I think it's hundreds of billions of dollars in cash, 300, something like that. And they have been pretty adamant that there haven't been attractive deals to make. So either lending the money or buying the money. So they've been sitting on cash, waiting for a good deal. And it seems that they have purchased Taylor Morrison, which again is a home builder and a mortgage finance company, mostly because it would tie into their already having a presence in the housing market. So they have multiple companies, I suppose, that help with like realtors and other parts of the housing market. So this would allow them to expand their market share, but also have overlapping services, cross-selling opportunities. 400 billion, it looks like what Gordon's saying, just shy of 400 billion in cash. So it allows them to do some cross-selling of services, and there might be some overlap, especially with the mortgage finance company, where they have cost synergies, which means they'll be able to fire some employees and combine the operation to make it more efficient. So they're seeing, even though prices in general for stocks are higher than they are willing to pay, they saw this as an attractive opportunity, mostly because of the synergies available. So this is, I believe, Greg Abel's first large investment in, especially an all-out acquisition of a company. We'll see if he continues a spending spree or if he continues to be disciplined. Talking about the continued spending spree, 10 billion is being invested by Berkshire Hathaway. So if we're counting right, 18.5 billion in the past month or so. So 10 billion is going to go to Alphabet. So Alphabet, also known as Google, Alphabet's the parent company. They are raising $80 billion from stock sales to continue as artificial intelligence rollout, buy more chips, build more data centers, all the fun things to make AI a reality. Was really interesting, since we're going to get to the SpaceX filing for an IPO, the largest IPO ever at $7.5 billion or $75 billion. Alphabet really just had to go out and one up them, where this isn't an IPO because they're already public, but and this was very not fully noticed by a lot of people, but they just had a larger IPO basically than SpaceX, where they are now $80 billion. And I think we talked about it last month, and we talked about it quite extensively in our new YouTube video for SpaceX that's going to be coming out in the coming days. It's still being edited. But there's going to be a squeeze on capital. There's only so much actual money around that is willing to be invested in these large companies, these large tech companies. Anthropic's IPOing in the coming months. OpenAI's IPOing in the coming months. SpaceX is IPOing in the coming months, and now Alphabet has just sucked up $80 billion of available capital. So it's going to get tighter to be able to find the capital to fund all these new IPOs and secondary offerings. And there's a lot of anticipation. There's a lot of excitement, hype, willingness to put cash into these what are seen as good opportunities for growth. But these are the largest IPOs in history, the most capital ever requested in a single year. So it's possible we might see some wonky things in the market just from these IPOs and these capital raises. But Gordon had mentioned before, Apple and Berkshire and all these other companies have very, very large cash holdings. So there's a lot of cash out there as well, sitting on the sidelines. So maybe it won't be a problem. Anything to add to anything I just said, Gordon?
Oh, yeah, just that 80 billion, that's like 4% of the market cap of Alphabet. They're
Yeah,
over
it's
a
pretty
$4 trillion
small compared to
company.
Alphabet, but it is pretty big compared to IPOs historically.
Hmm.
Uh, all right, so just a quick one. This was earlier in the month, but Elon Musk, who of course runs Tesla, also runs SpaceX and XAI, which was rolled into SpaceX. Um, uh, he sued OpenAI. He was one of the original funders of OpenAI. His whole lawsuit was about how OpenAI came out initially as a nonprofit and then transitioned to being a for-profit, which to be fair is a very I think reasonable lawsuit if you donate millions of dollars to this nonprofit and then they decide that no, we're actually going to make it a for-profit entity and keep your $3 million. Like that is, I think it was 3 million, however many millions he gave. That is a reasonable lawsuit. But ultimately, he lost the case against OpenAI. It went to in front of a jury, and the jury said that the statute of limitations had passed. That he waited too long to file the lawsuit, so we won't actually know if Musk was actually in the right for once. We'll just have to accept that it was out of basically statute of limitations. For SpaceX, I mentioned a little bit. I will cover that heavily. I'm going to instead say, please go watch our new YouTube video. Again, it'll be out in the coming days, hopefully next week at the latest. And we have 20 minutes of us just talking about SpaceX and the implications for the market. And yeah, there's plenty to say. Largest IPO ever, $1.5 trillion valuation. I think one thing that came out after the YouTube video was recorded, it came out a couple days ago, was that Morningstar finally released their analysis of the SpaceX initial public offering. I hold Morningstar in high regard. We use it for our clients and for our own research purposes. And they value SpaceX at $780 billion. So still a massive company, but about half of what is actually seeking. So it's saying that if it was properly valued and it IPOs at 1.5, that it would fall by 50% to its real value, which isn't necessarily what's going to happen. But it is interesting. I think that kind of comes out as what SpaceX was being valued at, just near $1 trillion, just underneath 800 or so, a year ago, before the shenanigans, I'll call it, with the merger of XAI, which in my mind does not have very much actual tangible value. That was what Twitter was. That became X, and then the XAI, which has Grok and that kind of stuff. And their goals for having AI data centers in space, and they merged them in together to have one larger company to have a larger IPO and all this kind of stuff. SpaceX was a somewhat attractive investment if they IPO'd without the XAI merger beforehand. But it seems like Morningstar kind of agrees and says, let's value this back to the some closer fundamentals of the company. Uh, and then yeah, Anthropic, our last note, they have filed for initial public offering, most likely before OpenAI, most likely over $1 trillion, and they have now raised money at a higher valuation than OpenAI. So they're now the number two AI company in terms of valuation behind Google. So interesting to see and interesting to follow. Anthropic and OpenAI had a whole tug of war. It really is an ego thing of who's going to IPO first and who's going to IPO at a slightly larger number. Like it doesn't really affect us in day-to-day life. I think our blanket recommendation is to avoid the IPOs and investing in the IPOs. They have a lot of hype behind them. If you must get into one, I would say Anthropic's the most attractive, but they all have a lot of risk associated with them. And it does, especially the IPOs, feel a little bit like 2001 with the dot-com bubble. Any advice around the IPOs, Gordon?
Oh, I agree 100%. If you know, force me to pick one to invest in, it would be Anthropic. I think their Mythos platform, which is the vulnerability finding tool that people are worried about that getting in the wrong hands. Um, but it's very strong, and so if companies can use that stuff on their own code to find and fix hacker vulnerabilities, then yeah, I can see the extremely high utility in that. Of course, they're creating kind of a race with themselves. They've always got to be coming out with something better so that bad actors don't, um, use that to develop their own hacking capabilities.
Yeah, that makes me think of what's been discussed for many, many years of as soon as quantum computing comes around, all of our passwords are going to be broken in 5 minutes because it can do so much computation. And yeah, AI, I guess, can be similar. Of course, quantum computing, at least the idea of it, would be more powerful than AI. But yeah, it very much is a arms with yourself. Can you break all the passwords, but can you just make a quantum computer that makes a more intense password or a more secure thing? Well, I don't know. I also, since I mentioned another classic Jeremy tangent here, some thoughts about Google. So I've been a big fan of Google. It's my family's largest position. Like my parents hold a good chunk of their retirement portfolio in Google itself. And for me, for a long time, is I just have seen Google as a very forward-thinking company. Specifically, they had the Lambda models that they were talking about in the 2010s, the mid-teens, where they were talking about this AI stuff, and they had been investing in it for 10 years. And then when the AI was ready and had to compete with OpenAI, they were like, here it is, and we can compete, and we've been working on this for a long time. I just wanted to point out or bring it back to attention, since we're all thinking about AI and not much about anything else. They have been since I think 2010 have been doing quantum computing. They have a lab and they have been working on quantum computing for many, many, many years. And I would not be surprised, however long it is, 10 years, whenever the next hype cycle is, maybe it's 20 years, 20 years ago was .com, 20 years from now will be quantum, who knows? But I think Google will be like, yeah, well, we've been just doing it in the background, and then this quantum computing startup will break it out, and then be like, well, we can compete too. So high praise for Google, though. Take a step back, it is also at all-time highs and heavily, heavily invested and high valuations. But to be fair, out of every company in the world, I like it the best in terms of just where it's at and its economic viability and what it does. But there's plenty of risks involved. Uh, any comment there, Gordon, with my tangent?
Oh, I don't know. I wonder if the advertising model might break at some point if everybody's using AI agents in order to find stuff, then why do people need to, you know, pay for placement on Google?
It's true. And then it could be more subtle and more problematic of just the recommendation from AI is tainted by whoever pays them the most. Now, I'm not saying that's happening or will happen, but could be problematic because, like, well, I really want a burger. Well, the only burger place that exists by you is McDonald's. Go get that. That would be problematic, right? Um,
Good point. Yeah. But I mean, yeah, we'll see how it plays out. But I think I can see some flavor of that. That's a great point.
all right. Well, I didn't see any Q&A come through this month, but feel free to come back next month, especially if any of you listening via podcast or on YouTube. We do the first Wednesday of each month at 6:30 p.m. Eastern Time. You can sign up on our website, silverstone.financial or silverstonefiduciary.com. Either one redirects you to the same place, and you can hover over our blog button, and then there's a webinar sign up link. So you can sign up and ask your questions live. We'd be happy to have you. All right. Well, here are our disclosures. You can read again. And I will see you all back here again next week, or next month, rather, July.
Good hour. Thank you so much, those of you who joined or who are watching um, later on.
Yeah. All right. See you later.